Welcome to this explainer. Today, we're untangling a massive financial mystery unfolding right now with the middle market advisory firm CBIZ. We are looking at a classic growth paradox. And let me tell you, the numbers involved here should make absolutely any investor sit up and pay attention.
Okay, let's just dive right into this massive contradiction. I mean, how can a company's revenue absolutely explode while its stock simultaneously plummets nearly 60% over a single year? It completely defies basic logic, right? But, as we put on our analyst hats and really peel back the layers of CBZ's recent moves, well, this paradox actually starts to make a whole lot of sense.
Just look at the sheer scale of this jump. Headline revenue ballooned from $1.8 billion in 2024 to an incredible $2.76 billion in 2025. That is a staggering leap. Now, this wasn't just a stellar year of organic sales, right? This was driven by one massive, transformative acquisition that completely mutated the size of the entire company practically overnight.
Part 1. Unpacking the Marcum deal and how exactly you digest a giant.
So because of really strict SEC and PCAOB rules regarding auditor independence, this wasn't your run-of-the-mill simple merger. No way. They actually had to split the transaction. CBZ bought the non-attest side, so we're talking the consulting and tax advisory business. Meanwhile, an affiliated independent CPA firm stepped in and bought the attest side, the actual financial auditing business. It is a highly complex maneuver, but absolutely necessary to stay fully compliant.
Now, you might be wondering, how on earth does CBIZ make money from a split business like that? Well, it all comes down to administrative service agreements, or ASAs. Get this. CBIZ generated over $650 million in 2025 simply by providing the back office staff, the technology, and the infrastructure to those independent CPAs. It's a fascinating structural workaround. They're essentially acting as the landlord and service provider. But as you can imagine, it definitely invites some extra regulatory scrutiny.
Moving on to Part 2, Q1 2026, Mixed Signals, the good, the bad, and the organic. Fast forward to the first quarter of 2026, and the earnings report revealed a really crucial tug-of-war. The good news? They beat profit expectations, posting an adjusted EPS of $2.50. But the bad news? They slightly missed on total revenue, bringing in $848.6 million. And here is the real red flag. Underlying organic growth, meaning the actual health of their core business when you exclude that massive Marcum acquisition, practically stalled out at just 1% to 2%.
To their credit, management didn't shy away from this during their earnings call. They explained that the sluggish organic growth was hampered by what they call temporary headwinds. They pointed to prior client exits that were meant to meet internal profitability standards, the completely messy realities of integrating the giant Marcum deal, some softer mid-market demand, and deferred client projects. Management actually estimates these temporary headaches dragged down organic growth by about 200 basis points in the first quarter alone.
Meanwhile, they've been pulling a classic financial lever. They are aggressively buying back their own stock. We're talking repurchasing over 2.5 million shares for roughly $168 million. By actively reducing the number of shares floating out there, they mathematically boost their per-share earnings. So, that really helps explain that EPS win we just looked at, even while the actual top-line organic growth is softening.
All right, Part 3. The debt and integration risks, or the cost of scaling up. $1.47 billion. Just let that number sink in for a second. That is the staggering amount of debt CBZ took on to fuel this massive expansion, sitting right there on their books under their 2024 credit facilities. This drastically, and I mean drastically, shifts their risk profile. It redirects massive amounts of free cash flow straight away from growing the business and funnels it right toward paying interest.
And their latest 10-K filing warns us that the debt is literally only half the story. Their balance sheet is currently resting on over $2.3 billion in goodwill. That's essentially the premium they paid over fair market value just to get Marcum, plus another $540 million in other intangibles subject to impairment. If the expected synergies from this massive merger fall flat, the value of those assets drops significantly. You combine that with those complex PCAOB and SEC independence limits we talked about, and management is walking a very precarious tightrope right now.
So the race is officially on. Management is highly focused on converting this newly acquired scale into enough free cash flow to hit a very aggressive goal. They want to deleverage the balance sheet to a net leverage ratio of less than 2.5 times by the year 2027. It's a clock that is ticking very loudly for the executive team. Which brings us to Part 4, AI and Future Margins, the Technology Catalyst.
So what's the plan? How exactly do they outrun this massive debt clock? Well, CEO Jerry Grisco is essentially betting the house on artificial intelligence. During their earnings call, he highlighted a brand new agentic AI rollout that's already showing early test case data extraction efficiencies of 20%. And they have some pretty bold forecasts, projecting that they will eventually double that to a 40% efficiency gain.
Here is the exact playbook they are running. By replacing all that manual, time-intensive data extraction with AI, they plan to free up their highly paid professionals. This allows them to shift their top talent toward higher-margin specialized advisory work. Ultimately, this strategy drives profitability without necessarily needing massive top-line organic revenue growth. Plus, it significantly increases their win rates against smaller competitors who simply don't have the scale to invest in these kinds of advanced AI tools.
And finally, Part 5, the analyst verdict, Wall Street's diverging opinions.
This table perfectly captures exactly how confused the market is right now. On one side, you have Sidoti targeting $86 a share. But then, look at the recent initiations from earlier this year. You've got BMO Capital at $33 and Stephens & Co. initiating coverage way down at $31. That is just a massive, massive divide in how Wall Street is valuing this exact same data and strategy.
Basically, analysts are picking sides in that paradox we started with. The bulls, well, they're weighing the rewards, right? The massive new scale, the Q1 EPS beats, those share buybacks that mathematically boost the per-share metrics, and of course, the huge promise of AI-driven margin expansion. The bears, however, they are looking really closely at the tangible risks. They see that stalled organic growth, that massive $1.47 billion in debt, and the messy, highly uncertain realities of integrating a company as incredibly large as Marcum.
So what does this all mean? Ultimately, as an investor tracking this explainer, you have to ask yourself one big question. Can this giant smoothly leverage AI to digest its acquisitions and absolutely dominate the mid-market advisory space? Or is $1.47 billion in debt simply way too much to chew? You'll definitely want to keep a very close eye on that organic growth number in the coming quarters, because honestly, that's going to be the ultimate lie detector here. Thanks so much for joining me on this deep dive, and I will catch you on the next explainer.